Welcome to episode 43 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special first-time guest on to talk with us about geopolitics, commodities, energy, everything under the sun. But I think it'll be a very interesting conversation. We follow some similar sectors of the market, and I definitely have similar opinions on where I think markets are probably headed and some of the different geopolitical and market cycles. But Chris, thanks for coming on.
It's my pleasure. Glad to be here, and looking forward to having a good chat.
Yeah, so I think we can skip the introductions. I assume most of the people that read my work are familiar with yours, but I think it'd be interesting to jump right into the geopolitical situation because it's been an interesting couple of weeks with Trump's appearance before Congress and what's been going on with OPEC, the gold flowing to the U.S. But I figured I could tee you up there and see where you wanted to take it. But I think it's a lot of moving pieces, and I think there's potential for some fireworks later this year. So,
well, there's that old saying from our good friend, the communist Vladimir Lenin, who said that there are decades where nothing happens, and then there are like weeks where decades happen. And that's actually the time frame that we're in. And I mean that from a long-term perspective. So you have there are many cycles, and I've spoken about this in the past on podcasts and conferences and everything else. And I'll just quickly touch on them because they're very important in terms of understanding that the things that we're watching today are entirely and completely normal within the context of cycles. While we don't know what the nuance of each individual type of action might be, the fact that you have an action is important, and I'll get to the point of that in a minute. So, what do you have? You have and I'll just bring this back to something that people can mostly understand. So everybody understands the business cycle. You're running sort of 7-year time frames, 7 to 10-year time frame on a business cycle. People understand that, they get it, and it's much like weather. People, at least if you're not living in the tropic, on the equator, everybody understands you get winter, summer, spring, and autumn. Okay, and so humanity operates in the same sort of fashion. We have right now a commodity cycle, okay, which has been extended largely as a consequence of ideological bullshit, basically. You have a lot of the renewable scam, or the idea that renewables are renewable, and the idea B, that they're going to replace fossil fuels, when we can evidence that in history we've never ever done that. In fact, we utilize today more wood than when wood was the sole or main contributor to the energy infrastructure. We utilize more coal today when coal was the primary energy driver, and so on and so forth. What we do is we stack on top of. Okay, so the idea that we're going to get rid of coal or natural gas or nuclear or oil or any of these things flies in the face of historical precedent. That's not to say it won't happen, but on probability, it's much, much less likely to take place.
Well, especially if it's less energy dense too, right?
Of course, it's less energy. I mean, the idea that you're going to utilize wind or solar or any of these things, we've always poo-pooed. We've pointed out the fact that they have a place, but that place the narrative did not fit the reality. Okay, and George Soros, although he's a curmudgeonly old bastard, and I don't like his ideology, he's a very smart trader, and he always said that you find the narrative that is wrong and you bet against it. And the narrative around renewables is entirely wrong, and the valuations that were attributed accordingly to it were entirely insane. Now, a lot of that was all predicated on the climate hysteria, which itself is a narrative which is wrong and bullshit. But you don't need to even have that same view as me. In fact, you might have a different view to me. What my job is to make money for my clients and for myself. Okay, and so that's identifying opportunities in the market which allow for relative low risk and relative high reward. Within that spectrum, the whole renewable energy complex and how it was paraded in front of the peasants was clearly not accurate with respect to the reality. So that the commodity cycle has been extended as a consequence of these narratives. And then they were exacerbated with things like net zero. So you had the Banking Commission, which all came together and said, you know what, we're all not going to finance anything in the fossil fuel space because it's killing the brown spotted owl or whatever the case might be, and the polar bears are going to die and so on and so forth. Fine. Okay. What it meant was a lack of capital expenditure within that space it was already in a bear market. Okay. So it's exacerbated and extended that particular cycle. But just as you have winter always comes, sometimes it might be a month late or 2 weeks late or 2 weeks early or whatever the case might be, we're still going to have the same cycle. So that's important because there has been this idea that, we've kind of gotten over that, right? We're not going to have that commodity cycle. That's not, I don't believe, accurate. So there's those commodity cycles. Then we have a debt cycle. We're at the tail end of the monetary cycle historically, and we can be 10 years off or something like that. But again, winter always comes, summer always comes. And the other cycle that we're in is the 250-year evolutionary cycle. So there's a whole lot of cycles all sort of coming to a head at the same time. And when you understand what those typically mean, we can go back and we can look in history where these types of cycles have hit and what the reactions in the markets typically are. You have what I call capital rotation. And so, if you think about, we've had a number of capital rotation eras in the past. We've had the 1930s, we had 1972, we had 2002, and I believe we're now in the next capital rotation cycle. In those cycles, you typically will have financial assets going into them. Financial assets typically are well overpriced. And we've talked ad infinitum around the Mag 7, the fact that you've got the 10 companies within the S&P, which now account for about 40% of the S&P, which as a percentage is far more extreme, by the way, than we had in the dot-com era when you had Cisco and all the other garbage that was highly valued. It was about 15%, by the way, of the S&P. Anyways, so we have these extreme valuations where the multiples are being extrapolated out basically to the point where the blue sky, everything grows to the moon. Most of that is in financial assets. And when I say financial assets, it's kind of growth equities. It's NVIDIA, it's Mag 7, it's all that side of space. That capital rotation typically rotates into commodities, into energy, into gold, into silver, which I believe is why we're watching gold do what it's doing. And it's doing it in every single currency around the world. And it has been, we've been pointing this out for the last 3 years, that gold has been moving in a bull market, not just, and predominantly because the dollar's been strong, it's masked that to some degree. But if you track it in all these other currencies, you could see it was in a wild bull market. Now it's breaking free of the dollar. Anyway, all of that is a predictive, or has some predictive qualities to capital rotation. Gold often is one of the first movers in that space. So here we are. And, the things that that you alluded to at the beginning of this conversation, OPEC, Trump's stuff going on, the Europeans wanting to go to war. Again, when you look at cycles, these are completely, totally normal. It's expected that when nations are bankrupt, they go to war. That's what they do time and time again. So watching the Europeans desperately looking to solve what they're looking to do is solve a debt problem. It's got nothing to do with well, I'd say nothing to do with Russia. There is a component to it, but by and large, the key driver to almost everything is economics, and the economics in Europe is somewhat problematic, shall we say. And so we're going to continue to see capital flight out of Europe. In fact, there are already capital controls in Europe, whether people realize it or not. Those capital controls are simply masked as regulatory, i.e., if you want to send money from your BNP Paribas account in Paris and you want to send it to Latin America, you are going to find difficulty in doing that. And you'll be asked all manner of different questions. Who are you sending to? Why? Who are the ultimate beneficial owners of the company that you're sending it to? What's your toothbrush color? All sorts of garbage. Now, those are masked as this idea that they are protecting you. Okay, it's AML KYC is what they call it. But what it actually is capital controls. And those are going to continue and increase and accelerate. And the smart money is already fleeing Europe. So again, these are all cycles that are predictive to some degree. And our job is to ensure that we are allocated in the most in what we deem to having the best risk reward sectors, being diversified across geographies, and basically managing risk. You can't eliminate risk, you can only manage it.
Yeah, I think that's a pretty interesting place to start. I do want to pull on the passive distortions that you kind of talked about, with the biggest companies being a huge part of the index, where you've got stuff like Costco trading at 60 times earnings or whatever it is, right? You go down the list of some of these ridiculous valuations, but is that, I assume at some point it's almost inevitable that it's going to work in reverse. We'll see capital flowing out of those names into other stuff that might be undervalued. I think that a lot of commodities and some of the stocks in those sectors would benefit, but is there a trigger event or something you're looking for to see kind of that capital flowing out of the big tech areas?
I don't look for triggers, and firstly, I'm not trying to trade. I'm a long-term deep value investor. So what I'm doing is I'm always running probability, and then on that probability you make asset allocations, and then you weight those allocations accordingly. That is tried and tested, and it works far better than trying to pontificate around what some particular event is going to be the straw that breaks the camel's back. You will typically only find out what that is in hindsight, and you'll look back and go, it was that, right? There's any number of things that can break that. And and I've studied history a lot, financial market history in particular. And even in hindsight, when you go back, you ask yourself the question, could I have known that that particular thing was the thing that was going to turn the market? And with all the history I read, you can never tell it. I could not, even after looking at it, sit there and go, I would have seen that. What you can see is probability. You can see that the probability of an event like that, one that has taken place, which then does cascade, you can see the probability exists, and you go, okay, yeah, that makes sense. X happened, and then Y happened. But trying to identify it beforehand is very difficult, because the other thing that happens is there are any number of things which can happen before it, any of which could have been that catalytic event, but isn't for whatever reason. So I don't think it's, from my perspective, it's not the smartest way for me to manage capital, just try and sit there and figure out what that one particular kernel is that's going to change things. I prefer to look at probability, look at the cycles, understand where I'm at in any given cycle on a time frame basis, and then allocate accordingly. And so, I mean, I could give you some examples of these setups, and what you will typically find, at least with respect to how we manage money, is that you will see the probability, you'll take a position accordingly, and then it'll just annoy you for 2 years or 18 months or whatever it is. And then something will happen. And again, that's something that happens even when you're in it, expecting it. You still sit there and go, oh, I didn't really think it would be that. And off you go. So, and we've had multiple situations like that, whether it be positioning in uranium, Argentina, oh gosh, any number of different setups. And again, we'll take positions and then we'll sit there and it'll just annoy us. It's very rare that we will do something and then immediately works in our favor. We did have that with natural gas, and we literally bottom ticked it by I think 2 weeks. But I will tell you that it was absolute fluke. The probability always existed, right? But knowing what and when that was going to move, just you can't tell. Well, I can't. I'm not smart enough. So with respect to things taking place with OPEC or any of these things, I don't really spend that much time on it. What I do know is that, for example, tariffs are inflationary. What I do know is that we're in this commodity cycle. What I do know is that we are going to already have and will continue to have geopolitical tension. We are likely to have both domestic conflict as well as international conflict, in particular in indebted markets. So when I say we, I'm not an American, so you're an American. Most listeners might well be American, so they might think of we as being American. America's an indebted nation, as is much of all of Europe. Western nations, by and large, I think are set up for that domestic conflict as well as then international conflict. Again, and that's not me having a crystal ball. That's just simply looking at history and looking at what happens when you have a certain financial and economic structure. It's entirely predictive. So, but then to say, well, what exactly does that look like? I don't know. Does Germany break away from the European Union? Does France? I don't know, but I know that there'll be conflict. It's inevitable. So those periods are typically stagflationary, i.e., shitty, stagnant economy with high inflation. And that sometimes catches people unawares, at least in these periods of times, because for our lifetimes, we've not really experienced that, which is why you get these cycles. For our lifetimes, we've experienced inflation typically being growth-led. It's the Asian tigers, or it's the emerging middle class in pick your country. And that's putting demand on commodities. And so then you have a commodity price boom. This is not that. This is supply-driven, constraint-driven inflation.
Interesting.
At the same time that you will often have a bifurcation globally. So like the whole globalization, the whole interconnected global trade gets shaken up, and you have alliances break down and other ones are reformed. That whole process is it's fraught with friction, and friction brings lack of supply and or higher costs. You can imagine like shutting the Strait of Hormuz, or the Suez, right? So the Suez has been under pressure. What does it mean? Well, it means your ships now have to maybe do another, 15,000 miles or whatever the case might be. That just increases the cost of whatever it is that you're moving on those ships. So that's the sort of thing that takes place, and it pushes up costs without and it's not as a consequence of demand. It's a consequence of supply chains coming under pressure and aggregate supply.
Yeah, interesting. I think the next place to go, as far as kind of your thoughts on energy in general, and you kind of mentioned that gold tends to lead these commodity cycles, and obviously gold has been one of the best performing assets of just about anything out there over the last couple of years. I think, was it Doug Casey said that we're watching kind of the last bull market for gold, and a lot of people kind of commented that we're going to see gold become a serious part of the financial system again, become money again. Do you think that we'll start to see other commodities really wake up? Like, I know once gold and oil like really get moving, then people wake up to it. But it seems like oil in particular has been one of the most frustrating things, at least for me, owning some of the energy stocks. But I'd be curious to get your thoughts on what the path looks like for energy in general, and maybe oil specifically.
Historically, in these timeframes, the best performing asset is energy. Does that repeat? We don't know. But so again, it's just a matter of waiting. And I don't mean waiting as in sitting at a waiting room. I mean allocation. How much percentage do you have in your portfolio across what sector, and so on and so forth. Our allocations towards the energy sector are pretty high. And that's as a consequence largely of value. So if you look at things just from a value perspective, you have just some of the cheapest assets on the planet sitting in the energy space, in particular in the offshore energy market.
Yep.
Okay. So if you looked at things from a bottom-up perspective and you ignored everything that I've just talked about, okay, forget about cycles, forget about commodity cycles, forget about geopolitics, any of that nonsense, and you just said, okay, show me what some of the cheapest assets on the planet are. That's where you're going to find them. And then you'll even find them down the value chain in things like pipe manufacturers, right? In service vessels and things like that service the offshore energy market. And so you go, well, either you're in this sort of Kodak type environment, right, where it's going away, or it's something else. Which is it? And even if it was a Kodak environment, if you're allocating, say, 5-10% of your portfolio to something that has that level of asymmetry, now you're in a position where you could potentially lose the 5%. You have a Kodak moment, and we're going to import asteroids, and I don't know, there'll be some energy source that solves all these problems. Fine. But you're not going to get crushed. Even if it's 10%, you'll get pissed off if you lose 10% in your portfolio, but it's not going to kill you. On the other hand, if that's not true, if we're not going to mine asteroids, if we're not going to have unicorn farts powering the globe, or any of these other things that Greta Thunberg might want, then we have enormous asymmetry behind this. And guess what? The participants in that market, most of them went away. In the bear market that I spoke about at the beginning of this conversation, remember that bear market existed, took out anywhere from 80 to 90% of these players, and then it was exacerbated by woke nonsense because Wall Street are all spineless, and so they're all sitting there trying to figure out what their pronouns are instead of financing new projects, which is fine. It allows asset managers like us to come in there and buy assets that they can't and don't want to buy. And now that's all changing. So now that, for example, with the Trump administration, he's going, hey, we've got an energy problem. Like, no shit, we got an energy problem, right? And Wall Street being what they are, they're just after money, man. They don't care about the brown spotted owl or the genders or any of this nonsense. They're following it because they're weak, spineless individuals, and they always have been. But the point is, they all now start coming to that particular playground. But there's not much to play in. There's really not much to play in. The other component that makes that energy space really interesting is that it is incredibly capital intensive. So if you and I are going to go out there and put a rig out in the ocean, it's going to cost us $1 billion at least on the rig. Then we're going to need at least 4 offshore OSVs, offshore service vessels. about 600 mil a piece. Like, and then if none exist and we got to go and build them, guess what? Many of the shipyards shut down, right? So like there's this entire literally physical constraint that exists around that system. What that means is there's a moat around the existing businesses to some degree, a moat in terms of time frame. Donald Trump can come out and say, drill, baby, drill. But that doesn't mean that shipbuilders, most of which are in South Korea and Asia, are going to suddenly just open up shop and start building the supply vessels that are required to service the offshore oil market. It's just not going to automatically happen just because he said it, or it's even been passed in some sort of legislature, or whatever the case might be, or even there's tax cuts. All of these things are very, very capital intensive. So I find that that's one of the most interesting areas. And then again, if you look at that whole entire sort of cycle pattern, energy always does well in stagflationary environments. So I think that's one of the most interesting within the entire sort of commodity complex. But I'm not also going to bet everything on that. I'm going to also, take positions in all sorts of other asset classes. Gold, of course. We could talk about gold and the fact that there's a massive divergence between the equities and between gold itself. And there's a reason behind that. Gold is being bought by central banks predominantly and sovereigns. Sovereign wealth funds and central banks don't buy Barrick or Newmont. They can't. Typically, it's under their mandates. They need to have gold, not gold equities. So what it tells me is that the participants thus far in the gold market have predominantly and continue to predominantly be central banks. Institutions are still not really participating, and retail are not participating. So there's a lot of energy still behind that. Now, on a short-term time basis, if, for example, I had leveraged long positions, and we don't use leverage, by the way, but if I was playing that game, I would probably be taking those positions off now. But on a long-term deep value time frame, I'm very bullish on gold. So what it means is we could easily see a pullback, but I would be a buyer in that environment.
Interesting. The some of the things you're saying about energy, like I actually wrote a piece on the offshore oil services names recently, and they've been basically beaten with ugly stick over the last 6 months, really, but especially to start this year. And like you said, if you start to pull apart what it would take to build a new one, or even just replacement cost, looking at some of these fleets, like I'm not saying they're priced for bankruptcy, but the way they're priced right now, I think, is that there's never going to be another upcycle or up leg in the. I mean, you look at some of these things that are priced like, I mean, just to throw out a couple names, like Seadrill, I think Noble are both trading below their like post bankruptcy share price, and that's with day rates significantly higher than they were. But to kind of move on specifically to a couple other things that I think are interesting with the coal sector, which is also kind of been relatively weak as of late. I think there's a couple in there that are starting to get very interesting and have high quality projects. And there's a couple that have management teams that want to empire build. But I do want to kind of see if you have any thoughts on where we are with coal specifically, because I know that it's a something you've been interested in the past, and I think it'd be potentially a good time to start looking in 2025 at some of these individual names.
Coal's interesting. I think we're setting up for a real supply squeeze. Demand continues to rise, particularly in India and China. So on the demand side, we're not seeing any reduction. And again, coming back to what I mentioned at the start, we never really actually go away from. We don't ever transition. We've never transitioned any energy resource. We've just gone to more and more dense energy sources. So the demand continues to rise. On the supply side, there's basically that's really dwindled off as banks have been refusing to spend on projects, back to Wall Street being spineless. Coal lending has collapsed within the Western markets in terms of bank lending, and there was a report just recently done. I'm trying to think of who it was, and there was I think it was from Rystad Energy, and the vice president of that, Steve Holton, I think is his name. And what he was in that report, he's talking about, because those guys look at the whole market, or not just coal. But what he was talking about was in terms of coal prices. He said, like, in previous highs in coal prices, we've always seen that it stimulated and sort of incentivized new projects and new lot builds and so on and so forth. And so back in 2022, we had fairly high levels, right? You'll remember this is when Ukraine was invaded, and the Putin blew up his own pipeline. Wink, wink. And so what the Europeans realized was they didn't really have any energy left, and so they started importing coal. So we had a real bullish move on coal prices. That did not translate into additional incentivized new builds. And so while that sort of has tapered off, there's this idea, or there's a market narrative at the moment, which is to say that we're good. We don't have any issues necessarily going forward, and I think that's wrong. So if you look at China, for example, China is building over 100 coal-fired power stations at present. India's building a lot. So basically, structurally, there's a lot of pressures, and overall growth in energy demand has not. It's not keeping up with consumption, and I think we're going into probably, I'm going to say more like 2026, is that's when I think there'll become a broad realization of that. The time, however, to invest in these things is well beforehand, because you never really know when it's going to start inflecting. The other cool thing with coal, by the way, is that a lot of these coal mining companies spit out very healthy dividends. So you get paid to wait.
Yeah. No, there's definitely a couple that are pretty interesting at current levels, and I'm hoping to get a chance to buy them here sooner rather than later. But as far as other commodities that you find interesting, like, I've started to look into steel and agricultural, some other commodities. I know got a couple buddies who are very bullish on lumber long term, but are there any other kind of spaces outside of energy, precious metals, that you think are maybe worth a closer look at current commodity prices?
Well, we can step out of the commodity space for a minute, although we're in a little bit. So Argentina is something that we started investing into in, what was it, October, I think, 2022. We had to wait 2 years, and then it took off like the police were after it, for a whole host of reasons. We've written fairly extensively about it. If people are not familiar with what's going on in Argentina, I would suggest you start educating yourselves. It is still offering enormous value. The entire market cap of the Argentinian stock market is fractional. It has, I could go on and on a lot about Argentina. Banks, for example, which survived under an environment of such high inflation that there was no credit, there was no lending market. Imagine running a bank when you don't lend, and then stabilizing the currency such that you can now start bringing on consumer credit. Like, your expansion multiples on that are enormous. That's the situation Argentinian banks are in today. And they're up 10x or something like that already. So we've done very well thus far, and sure, we could have a few pullbacks, but that is a very, very interesting space. Where we're invested in there is across the board. We're in some energy companies, we're in commodities to some degree, agriculture, all sorts of stuff, banks. But yeah, look, you can go and we've talked about it in our newsletter. Like we've put together basically our own ETF, if you will. And there's like 7 companies you can go and buy, and you basically own the market. There is an Argentinian ETF. I don't particularly like it because of the weighting of one of the companies in there, which I'm not that favorable towards. But even that, it'll do well, because once Wall Street wakes up to Argentina, and even just takes a tiny percentage allocation, it has the potential to do some extraordinary things. Consider when we first invested into it, you could buy the entire Argentinian stock market for about 30 billion.
That's probably too cheap.
Well, you were buying companies with PEs of 3, 4 within that. Now think about this from the perspective of a Wall Street allocator, and you've got Apple at 3 trillion. I haven't even looked at what Apple is trading at now, and that's a decent company. But you got Meta, you've got the Mag 7. When stuff starts leaking out of that, and it's going to happen, then it's going to go elsewhere. I'm not suggesting that it's going to pour into Argentina. Don't get me wrong. What I'm suggesting is that Argentina is so tiny, right, as a percentage, that just a small amount of capital in there can and will move the needle in a big fashion. It's already moved up a lot, but keep in mind that it's not been moving up as a consequence of FDI. Much of the investment that's taking place in Argentina now is capital repatriation. It's Argentinians realizing, holy shit, things are good at home. Instead of trying to keep pulling money out of this disastrous country and putting it into Swiss bank accounts, I'm going to start repatriating a bunch of it back home. Milei's put in anyway, I could talk on and on about Argentina. We'll sideline that for the minute. You asked about other things. The other thing that we are invested into of late has been Chinese tech. Beaten up, left for dead. All the Westerners decided that the Chinese are idiots, and there's a whole host of reasons. But by and large, your large institutional Western capital fled the market, fled the large cap stocks in China, to the extent that you now have some of the biggest, fastest growing tech companies in the world with, one could argue, superior technology. I'm not here to argue one way or the other. I don't really care. But that is an argument that is being made. Trading at massive discounts to US or Western tech. So we're buying that, or have been. What else? We got a whole lot of stuff, but that's some stuff for people to chew on.
Yeah, interesting. Now I started to look at Colombia and Brazil, especially if you kind of assume that we're going to get a potential presidential changes there that would be positive for some of those companies in those countries. But I think South America, as if you kind of just take a blanket view of it, it's pretty cheap. But I think a lot of investors are caught chasing the shiny thing, whether it's crypto here in the US or different stocks. But I do want to kind of see if there's get your thoughts on the big picture look at bonds, because I know there's a lot of people that are expecting interest rates are going down and it's happy days from here. TLT is going to go up. I have kind of no short-term view on interest rates. I think longer term interest rates are probably headed a lot higher for a variety of reasons, but I think anyone trying to hold some of these long-term bonds to maturity is asking for trouble. So I don't know if you have any thoughts there on holding sovereign debt in particular, but I think it'd be interesting to get into maybe what some people are missing on kind of the debt market side of things.
Again, cycles of history. Look, we have some of the highest debt levels in the world with the lowest interest rates. It doesn't make any sense. That's just common basic understanding. Okay. In terms of cycles, we're at that. I believe we ended the bond bull market. Back, you could argue it was 2016, and then we had the bump in 2020 with the COVID scam. But either which way, I feel like we've turned the corner on bonds. I would not own bonds of any shape or description. I see no reason why it should even make its way into my portfolio. So I don't own any bonds. I have no desire to own any bonds. That's not to say that there's not tradable opportunities there. But again, I'm not a trader. I'm a long-term deep value investor with a time frame that runs 3 to 5 years or longer. So no, in inflationary environments, you get hammered with bonds. And so that they can cap bond yields, but ultimately then you just get it inflated away so that your dollar doesn't purchase. Either which way, either the interest rates hammer you or the inflation hammers you, or a combination of the two. It doesn't make any sense for me to own bonds. No. So that's my take on bonds. I have no interest whatsoever in owning them.
Yeah, I think a lot of people are missing the forest for the trees on that one. But as far as kind of starting to wrap things up, if we can maybe circle back to the geopolitical side, what are certain things you're looking for as far as kind of different parts of the world or different regions? Like I know a bunch of people have talked about the multipolar world kind of starting to shift from the unipolar one we've been in, and people have started to talk about gold becoming money again as far as the financial system. Like what are some of the big picture things that you're kind of watching as far as a geopolitical stage and how it maybe intersects with financial markets?
It's interesting, look, we've been writing about this for years now. Again, in terms of cycles, that these things are going to happen. You don't know necessarily what the nuances of it are. Going into the last presidential elections in the United States, if you look at the narrative, you look at what narratives get built ahead of time. And I would suggest that Elon Musk is basically the marketing arm at the moment for, he puts out the narrative. So you can kind of, and I was watching what he was saying. So, and a lot of it was just humorous. You might recall him challenging Maduro in Venezuela to a cage fight, and shit like that, which is hilarious. But there's a reason behind it, right? It's not purely entertainment. If you look at the policies that are being implemented by the new administration, they are looking at consolidating North American power in that north-south realm. He's not concerned about Southeast Asia. He's not worried about Taiwan. There's been no comments around Taiwan, or very few. There's Europe he doesn't really care about, clearly, right? He's interested in Canada, Panama because it's a geopolitical choke point. It's absolutely, completely, totally necessary for the United States to control that. Venezuela, because it has some of the largest reserves in the world, energy reserves. Also, the crude that it produces is suitable to US refineries, which is important, whereas Saudi crude is not. And then you've got Argentina. And if you look at the relationship between Milei and Elon Musk, and that these guys are basically like, best buddies or so. Anyway, the point is that entire regional north-south is being pressured by the US administration. And what I suspect we're going to see are increasing trade, in Mexico as well, is increasing trade deals and a consolidation of power across that. Then to your point, you've got a bunch of lefty governments in there. Why is it that we've seen with the exposure of US aid, and again, Elon Musk prompting this, which is proving that Bolsonaro, for example, lost the election as a consequence of US interference in that government. What they're doing is they're setting the stage to say that the current government in Brazil is illegitimate. That's what they're saying. Okay. And so there's huge, and same thing with Venezuela. At the same time, they were super buddies with Milei. So you're seeing this carrot stick diplomacy being utilized across the North-South region. Colombia is coming up for elections next year, and he's out. I mean, he's hated domestically in Colombia. His policies have been shit. The US has been pressuring him. So I think we're going to see a change of government there. I think we'll probably see more trade deals. And now we just look at valuations in these countries and what assets do they have and so on and so forth. So I'm actually quite bullish on the entire Latin American and South American realm. Easily at the top of it for me, however, is Argentina. So that's important. At the same time, I think you're going to see a consolidation within Southeast Asia of Chinese influence. In fact, we're seeing it. It's not me pontificating about it. That's happening. In fact, that entire regional bloc, almost from Istanbul through to Jakarta, is increasingly Russian Chinese influence. And the facilitator of trade within that is the UAE.
Interesting.
So regional blocks.
Yeah. I think it is interesting to watch some of the stuff going on with tariffs, and you see kind of Canada and Mexico, this Willy tariff, or is it just kind of a bargaining chip? Before I forget, though, to go back to Venezuela, have you seen that Chevron basically got their operating license revoked recently? They basically have 1 month to wind up their operations. Do you think that there's some deal behind the scenes there that they're going to let Venezuela start pumping more, or what do you think that plays out? Because that would be, like you said, a good fit for the U.S. refineries.
Venezuela's the wild card, Ben. So I was down there last year, a few months back. The Chinese are involved. There's a Russian warship in the harbor. Venezuela is interesting in that they are beginning to skirt a lot of the sanctions and everything else that has been hampering the country. So on the financial side, like banking there, the banks all got shut off. But now you have stable coins. So you can move capital via USDT in and out of any country outside of Western banking infrastructure. You don't need New York intermediary banks in order to do that. Okay. So that's the first thing. So now capital starts moving. And look, it's not your average man on the street. But in terms of large pools of capital, you can do it, and that's what's taking place. You also don't take currency risk because you can do it in dollars. In fact, you can have stablecoin in any sort of stablecoin. You can have euros, sterling, whatever. But dollars is typically the accepted and chosen medium of exchange. So that's taking place. The second thing that has been happening, which is interesting, is the movement of physical goods, which was always constrained by the US Navy. So if you were a Venezuelan trying to move oil to wherever, the US military would just stop you. With all their shenanigans trying to fight wars in the Ukraine and keep the cocaine dwarf going and so on and so forth, that put the US in a more stretched military position. And what we started seeing was Chinese ships moving those goods. And really, what I suspect happened is the Americans said, you know what, we don't really want to piss off the Chinese just yet. We're fighting with all manner of other people. We've got the Russians on the border of Ukraine. We've got other problems to deal with. We're going to just let it pass. So basically, you've started seeing goods moving, physical goods moving on Russian vessels, and then capital moving via blockchain technology. Still early days on it, but it's seen quite a bit of actual growth in Venezuela. So these are all economic consequences, and then to some degree they're backed by quasi-military alliances, if you will. At the same time, if coming back to what I just mentioned with the Trump administration, it's very clear that they want to control that north-south corridor all the way. They're not going to be favorable at all to having Chinese or Russian influence controlling Venezuela. So, like I said, it's up for grabs. They tried and failed with two-color revolutions in the country. The CIA did, and they admitted to it. So we'll see. But the assets on the ground are unbelievably cheap. The problem is that the infrastructure is dilapidated, and it'll require quite a bit of capital expenditure. And of course, with the risk of conflict or the risk of stupid government policies, no one really wants to deploy huge amounts of capex into something where often your time frame, your paybacks on that are multi-year, if not decades. But again, the prices just keep moving down. So you're in this unique situation now where you can actually buy assets. So if you take an example like this, let's say you were to buy a US asset, and it had some R&D that's required on it, okay? And your time frame to paying it back is 30 years. That's quite normal, okay? In Venezuela, that 30-year time frame has just gotten constricted and constricted and constricted as a consequence of the underlying price moving lower and lower and lower, such that you're in a position now where you can buy something, maybe spend a few $1 million fixing it up and have it being cash flowing in 4 or 5 years. That's a hugely unique situation, but it's priced according to the risks, right? So,
no, I think it's super interesting when you look at some of the oil reserves they have and other things. A couple of people pointed out that Rubio, Secretary of State, he's kind of a mixed history, I guess, but at the same time, that definitely, I think, does show a little bit of a focus on what's going on in Latin America. Before I do let you go, I do want to ask kind of one last question on Canada, because I was talking with a friend about some of the Canadian oil sands names and some of the things going on there, where with tariffs and other stuff that's kind of getting tossed around, if we do see any significant tariffs, that means big issues for their economy. And then he kind of was basically saying that extends to real estate, which is clearly extremely expensive in Canada. It's not the only place, but it's definitely, I think, in a bubble, and it could be interesting times for their economy in general. But I think the Canadian oil sands companies are pretty interesting as far as having long live assets and lots of reserves, and go down the list, right? What do you think the kind of geopolitical picture looks like for Canada as far as U.S. relations and how that might play out?
Yeah, I think it'll be fine. I think it's a bit of a storm in a teacup. If you look at Donald Trump's typical strategy, he runs in there, yells and screams, and he comes out with wild things, and then he just organizes. So it's like that picture behind you. Like, let's just say it's cost you $500. Okay, and it's a $500 picture. I'll come in like, I'll buy it for $1. And you're like, I'm not giving away for $1. You know? I'm like, oh, okay, maybe 200. And now you're like, oh, that seems a bit better. Whereas if it's a $500 item and I'm going, I'll give you 200, you're like, it's $500, brother. So like, it's just, that's his strategy. He comes out, he's like, we're going to take Panama, right? And then the president of Panama comes and goes, no, you're not. He goes, watch us. You know, and it's just that's, and that was before he was actually inaugurated, right? Now, when he sits down at the table, he's like, well, maybe we don't take it, but let's do a deal. So now it's like, it's just a tampering down.
Sends in BlackRock, right? I saw that BlackRock made some investment down there, but
they bought a bunch of ports. Yeah. So anyways, I think ultimately, that's the strategy. And look, the Canadians are in a that they're not really in a very strong position. They're going to take whatever they're given. And so Trump's just going to basically make sure that there's no. He's just going to do a deal, and they'll take the deal. But ultimately, I think it'll be fine. I think it's the history of the countries. The whole obviously didn't like Trudeau, but then Trudeau's not even a man. I don't know what he is. He's a eunuch. And he's going to be gone anyways. So, and I don't think it's his personality driven either. It's just a matter of trying to get it a good deal for America. But ultimately, Canada's going to take what it gets offered, and that's what'll happen. But I don't really think it's going to be actually that egregious.
Yeah.
Yeah.
Interesting. I guess before I let you go, I do have to ask you my traditional closing question, which is what book should I add to my reading list? Can be history, finance, anything you think I'd find interesting.
Oh gosh. Okay. There's a friend of mine who wrote a book. It's called 180 Degrees, Unlearning the Lies You've Been Told. It's like a Bible. It's a very thick book, and it's absolutely a must read. In fact, I think it should be mandatory reading, probably for like 16-year-olds and up. That's my go-to. 180 Degrees. It's written by a gentleman by the name of Fergus O'Connor Greenwood.
Okay, I think I've seen him. What was it, Palisades Gold Radio? I think he's been on a couple podcasts I've listened to, but definitely an interesting character. I'll have to check his book out for sure. If my listeners are looking to find some of your work, where should they look for you on social media or any other places?
Yeah, I don't use social media a whole lot, but we do have a Twitter handle, which is @capitalistexp. Otherwise, our publishing business is at capitalistexploits.at, and our asset management business is glenorchycapital.net, where we manage money.
Awesome.
So find us there.
Well, I really appreciate taking the time to come on. I think give our listeners a lot to think about. But with that, I think we'll be wrapping up. Thanks for stopping by, and we'll see you next time.